Buddy, welcome back to the Financial Freedom Show. My name is Rob Berger. Today, this is a live show, a live video, but what we're going to—it's not a live Q&A. We're going to talk about a specific topic, and that is how to stress test a portfolio or a retirement plan. Part of that includes your portfolio. And once you get the results of the stress test, which you may not like, what might we do about it? How might we address the potential that things could go not so well during retirement? So that's what we're going to cover today. And then if there are folks that actually join live and have some questions, I'll do my best to respond to them afterward on this topic. So this has come up for me in a couple of different ways. There are a number of ways that I think we should stress test a retirement plan. And I'm going to cover 5 of them. There are perhaps many more. But I'm going to cover 5 of them in today's video and show you some tools how you might actually stress test your own retirement plan in one or more of these five ways. And then, of course, maybe some things we might do about it. The thing I want to stress, and this is a stress test, so something we want to stress is we shouldn't think of this as sort of an after the fact. We've got our plan. Oh, sure. Let's imagine we'll live to be 140. No, that's not one we're going to use, but it's actually an integral part of actually coming up with your plan, because as you go through the different stress tests, and all a stress test is asking a what if that will either decrease your income or increase your expenses, right? So what if I have a health issue that requires me to spend $100,000 when I'm 87, which, by the way, is one we're going to look at. That's all a stress test is a what if scenario that either decreases your income in retirement or increases your expenses. And then we can look at other types of what if scenarios, like, for example, delaying Social Security. We will look at that as a way to address some of these potential stresses that can happen during retirement. One of the benefits of doing this, apart from just preparing for the worst but hoping for the best, is that I think it can give us some more confidence in our retirement plan, because, and I can speak from experience, retiring can be stressful, even if, by all accounts, you've got plenty of money to retire. So I think this is a really important part of coming up with a retirement plan. So we're going to use 2 tools today. Empower, which is free, used to be called Personal Capital. I'll show you that. And I use both of these tools. We're going to look at Empower primarily, but then also going to spend a little time on New Retirement. And we'll talk a little bit about the differences between the 2 tools. New Retirement has a free version, but to get all the benefits, it's a paid tool. And I think it's very valuable. Again, I use them both, but Empower is free, and we're going to start with that. And we're going to look at 5 ways to stress test a portfolio. So let's start with Empower. I'll show you that. And Empower, again, I'll leave links to both of these tools below the video. And maybe I'll take me off the screen for now so you can see everything. This is the retirement planner. You get to it by going to planner and then retirement planner. One thing, and this is all, by the way, hypothetical data. This is, you'll see the name Rob, but this is not my data. But one of the things before we actually get to the retirement planner, we should look at profile. Profile, and I've given I don't know where I came up with Belinda, but that's the fake name I've put in here. If you edit your information here, you'll actually see retirement age, and that's where you can set your retirement age. Obviously, I've got it as single, again, just trying to keep it simple, but if you're married, you can put in your spouse's information as well, and that's obviously very important in a retirement plan. And once you do that, then we can go back to retirement planner, and I'm going to open this up. So we have a base plan. In this hypothetical, the person is 60. They're going to retire at 65. That's what the little palm tree there is. And they're also going to start taking Social Security. And we'll look at how they came up with that number. That's a calculated number, that $24,792. And we're going to plan for 30 years, which is a nice way of saying we're going to die at the age of 95. So the first stress test we're going to look at, we talked about this in the previous video, is longevity. We may plan for a 30-year retirement starting at age 65, but what if we live to be 100? Now, one way we could do that in Empower is just edit the assumptions here. And here's life expectancy, and we could change this, right? But of course, the problem with doing it that way is that there's no comparison. I want to be able to compare things. So we want to create a new scenario. This is one of the absolute best features of any retirement planning software. And New Retirement does it as well. Many of them do. but it's creating a new scenario. We'll call this just, live to 100. And you can copy it from, if you have multiple plans at the moment, all we have is the one, but you can copy the data from any plan that you have in there. And you see this simulate past recessions. We'll actually come back to that in a minute. So at the moment, these two scenarios are identical, right? So all we do is come in here, edit the assumption. We're going to live to be 100 or whatever you want, but we're going to put 100 in. And it recalculates. So what this is doing, it went very quickly, but this uses what's called Monte Carlo simulation. It runs, in this case, 5,000 simulations. Now, not to get too down into the weeds on Monte Carlo analysis, but the inputs into Monte Carlo's analysis are really important. And by inputs, I primarily mean average returns and volatility of stocks and bonds. Empower uses historical data, of course, which I think is, for the most part, the norm, right? And they actually base it in part on your specific asset allocation, because although in this one I've entered accounts manually, if you're using Empower, you can connect your actual accounts. It then knows your actual asset allocation and can base return assumptions on your actual investments. And by the way, there's a paper that they go into here where you can get all of the details, and you'll find it right here. This link takes you to that paper. Okay, so what do we got? Well, by and large, we were at 81% chance of success, and it dropped to 74%. What Empower says is you want to aim for at least 80%. I think that's, for the most part, probably accurate on a Monte Carlo analysis, particularly if you're just using historical data. So 74% would give me a little bit of concern, but this shows you, okay, we live an extra 5 years. That means we spend more money, and we drop our chances of success down to 74%. Now, you may say, well, Rob, I don't think I'm going to live to be 100. I'm willing to take that chance. It's a really important point. What you do with these results is, of course, up to you. I think the key is to understand what they are. Now, we'll look at different ways we could address this in a minute. But before we do that, I want to add another scenario and look at another risk factor, and that is sequence of returns. So the idea behind sequence of returns risk is, and I think this is one of the biggest fears of retiring. You're ready to retire, and you do, and then the stock market just tanks. And for like the next 3 or 4 years, it's down 20% a year or whatever. I think that's probably one of the biggest fears of retirement. And it's a valid concern. So New Retirement has a way to deal with that. And that's this simulate past returns. So we'll just say, we'll just call it a recession, I guess. Well, that's what we'll name it. We could base this on live to 100 and combine our stress tests, right? But for now, and that's, I think, a good thing to do, and I'll leave that for you to do on your own. But I think we'll just base it off my plan, and we're going to simulate past recessions. And here we have to put the age. So we're going to say when we retire, which is 65, and we have two. We can do the financial crisis starting in 08 or the dot-com crash. I think the dot-com crash is probably the worst of the two. I mean, the financial crisis, dropped 50% over a certain period. But dot-com, we had three rough years in a row. So let's go with that. And it's interesting, this may surprise you, 90%. So it actually went up. And one possible reason is we're simulating that period, and it was really bad, but then there were really good years afterward. But the other thing is this, and this is, we were saving more money until 65, but that's when the simulation hit. But it's still giving us 90%. And that really surprised me when I was running these numbers before starting the show today. Now, we could do, we'll do recession, just out of curiosity. We'll do recession number 2, and we'll pick the financial crisis. Same thing, 90%. Actually, it was 91. It's dropped 1%. I wonder why that happened. In any event, at least in this scenario with all of these assumptions, that recession actually didn't hurt us. And that surprised me. Now, by the way, you could keep doing this, right? We could run a new scenario. I'll just call it recession number 3. We'll simulate it. We'll just do the dot-com, but we'll start it at 62. So that's 3 years before we actually retire. actually goes up, I guess because we're effectively investing at lower prices. Maybe that's the reason. So, but this really brings out a really important reason why stress testing is so critical, is that the results can sometimes surprise you. And so that's why I think stress testing is important. And they can surprise you not only in the sense we just saw, where maybe our chance of success goes up when we thought it would have gone down, but another way that they can surprise us is maybe we thought that the chance of success would go down, but we thought it would go down by a lot and it only went down by a little, or the opposite. We thought it would only go down a smidge and it went down a truckload, right? So that's, I think you learn probably more about your retirement plan doing stress testing and running what if scenarios than just about anything else. All right. We'll look at a couple more. Let me, I'm going to delete some of these just to clean it up a bit. We'll do another scenario and we'll just call it inflation. And we'll go down to edit assumptions. Now, here with inflation, the only way you can change it in Empower is an overall inflation rate that will apply throughout your entire retirement. With new retirement, you can get a little more nuanced with it, which I'll show you in a minute. But we'll just go to, I don't know, 5.5%. And it dropped it pretty significantly, down to 62%. So inflation matters a lot. And of course, what that effectively does is increase your spending, right, every single year. And so inflation is a pretty significant. So we've talked about living to 100. We've looked at sequence of returns risk. That's number 2. A third one we'll actually look in new retirement is market returns. So in other words, with sequence of returns risk, you retire and you have a bad 3 years or 5 years. But there's also the possibility that maybe you don't hit a recession or a bad market when you retire, but just the overall rate of return over your retirement period is just lower. You were maybe expecting 8% and it's 7%. Empower doesn't really allow you that level of control over the return data because they're using their own historical data in their engine. And so you can't really change that. In new retirement, you can, and I'll show you that in just a minute. The last thing, though, the fifth one, is a spending shock, and we can look at that in Empower. So we'll just do, I'll call it a spending shock. Why not? And we just come down here. So you can see we can have income events. So you could model, for example, an inheritance, right? But we also have spending, and we can do a number of things here. But here's healthcare. And we can say, let's imagine we're gonna hit a spending shock of $33,000 a year, and yearly for a set number of years. So we'll say when we are 87 to 90. Obviously, you could put in any number of scenarios you want, but we'll do it with this one. And you can see it also has a pretty significant effect on our chances of success. So when we look at these, the recessions maybe didn't hurt us as much, but the chance of living longer than planned, the chance of inflation being higher, and the possibility of a spending shock all really hurt our plans. Now, here's where you have to assess how likely is that risk, what is the ability that I might have to reduce my spending. But here's where we can now run some what if scenarios to maybe address these. And we'll pick inflation since it ended up with the lowest chance of success, 62%. Now this is in a way maybe the hardest one, I think, to address, because it's just a consistent every single year you're spending more money and it never ends. Well, it does when you die. So what can we do about that? Well, let's look at retirement spending. We could work an extra year or two. So we have a 62% chance of success. What if we just worked one extra year? So it goes from 62, and this will update, there it goes. It goes from 62 to 67%. And I wanted to show you this. Working one extra year is huge. And it's huge because you're kind of getting a twofer, right? It's one less year where you're spending out of your retirement savings, right? And it's one more year to continue to save for retirement. So you kind of get a twofer. And if we say, well, and you may not want to work to 66, these are, I'm just showing you the numbers. You'll have to decide what you want to do. But let's imagine now We work 2 more years. Well, now we're up to 71%. And then, and this is what I wanted to show you Social Security. You can, of course, go in and get your own Social Security statement and put your own number in, or they can make it an assumption based on your income and whatnot. And that's what I've used here. But let's just say we bump this up to 67. So we're delaying for 2 years, but we're getting a higher amount. Does that change our 71%? Now we're up to 76%. And you can start to see how, I don't know how significant you think these changes are. I guess they are kind of significant, but we went from 62% chance of success to 76% chance of success. And we could continue to make changes. Maybe we can save a little bit more money between now and retirement, right? We could look at this and say, well, wait a minute, we're going to retire at 67, but what if we wait till 70? I've heard that's always a good thing to do. Look at that, it jumps to 84%. And then, by the way, we could start to combine stress tests. Well, what if we live to be 100? Now what? Now we're kind of combining, right? We're back down to 76%. So you can see how you can combine these in different ways. And I think where it's going to lead you to a place where you, one, at least know the numbers, know how different possibilities or outcomes affect your retirement plan. You can decide, particularly, I tell you, the question of when to retire and when to take Social Security are two of the most important variables in creating a robust retirement plan. Now, if you're already retired, and particularly if you're already taking Social Security, obviously those two items are now off the table. I suppose you could go back to work. But those are really important and have a big effect on the chance of success of any retirement plan. So if you're not yet retired, work with something like Empower, or again, I'm going to show you New Retirement briefly here in a minute, to run these different scenarios, stress test the portfolio, and then sort of run these what ifs to see how they hopefully address those stresses. All right, let me briefly show you New Retirement. New Retirement is a totally different kind of tool. You can link your accounts. This, by the way, is a demo account, but for my personal account, I don't link them. I just type them in, balances. Unlike Empower, New Retirement doesn't look at your asset allocation and base results on that. In fact, you set your own assumptions when it comes to returns. Now, there's pros and cons. I like the fact that Empower just automatically uses historical returns and makes it easy, and it gives you some good information. On the other hand, I would like to be able to have some control over it to run some what if scenarios, and I can't do that in Personal Capital. I can do the recessions that we looked at. But with New Retirement, I can. And the way it works is for each account, and we'll just use this traditional IRA here, you can see it says rate of return 5%. If we hover over it, you'll see it says pessimistic 5, optimistic 9. Where does that come from? Well, if we edit this, I put those in myself. Now, there are different ways to decide what numbers you're going to put in here. Obviously, I would look at your asset allocation for each account, and it matters. You don't want to just assume the same rate of return for all accounts if the asset allocation is different from one to another. And maybe you have a lot of bonds in your traditional IRA, so your expected return isn't as high. That matters because that's going to affect your required minimum distributions, right, down the road. But the point is, you're going to put whatever you put in here. Again, you can use Portfolio Visualizer to look at historical data. A lot of folks do that. But once you've got that data in there, we'll go to the overview. You see that we've got a 15% chance of success. That's not very good, is it? Well, we can go over to assumptions, and you can see that I'm using the pessimistic assumptions, meaning the pessimistic return for each account, and also the pessimistic inflation rate. Let me just briefly show you that. If you go to assumptions, rates, I have 4% as pessimistic. So it's using a high inflation rate and low returns. And with this particular plan, it gets you a 15%. But you can easily say, okay, well, what about average? And it just calculates the average of the two numbers you put in. So we had 2 and 4% for inflation, so it assumes 3. If we had 5 and 9, it would assume for returns, it would assume 7.5. I think if I've got the math right. And we're up to 93% chance of success. But the thing I like about New Retirement is it's very easy to then change these and look at the differences based on those assumptions. You can also, let me see if I can find it. It's in Explorers. You can run a what if, and there are different what ifs that they have. But one of them, let's see here. It's interesting. These change over time. Because I was looking at this earlier, and it was it showed you a 1% increase or 1% decrease in returns, and now they're not on here. I wonder if that changes every time you reload, or if they just changed it since I last looked at it. Maybe they did. So what you could do then is, we'll go back. I'll show you a different way to what I was going to try to do. If you go to your plan, you go to your accounts. We were looking at this IRA, right? And remember, we assumed 9% and 5%. But what if you said, well, what if I want to change my assumptions over time? So for example, you could say as you get older, maybe you'll have more and more in bonds. And so you want to change it. So at, I don't know, let's say at 77, you think the optimistic is only going to be 6% and the pessimistic is 2%, because you'll have a lot of bonds. Again, you could do this in countless different ways. But that's the level of detail you can use with new retirement that you can't with Empower. So again, there are pros and cons to both. And then you can see how that changes for all of your assumptions, including average. I don't know if you remember, but I think the average was like low 90s just a minute ago. And because of that change in assumption, it drops to 88%. The last thing I want to show you, and then I'll look at your questions, is you could model inflation where you say, look, I think inflation might average, say, 3%. And inflation numbers just came out this morning. They ticked up a little bit, but you might say, but for the next, 5 years, I think it's going to be 5% or whatever. How do I model that? If you go to assumptions, you can't really do that in inflation. It is nice that they give you different metrics, like you can separate your medical costs and have a different inflation rate. But there's nowhere in here to say, well, I think it's going to be 5% over the next 5 years. But what you can do is go to your expenses. In this hypothetical, I've got just a $12,000 a month expense for lifetime, but you can add an expense. We can call it an inflation adjustment. And you could calculate based on your spending what you think that amount would be. But let's just say it's, I don't know, $10,000 a year for the next 5 years. So you could say when you're 67 and 4 months, and 10,000 seems a little ridiculous. I don't know what the number would be. You have to do the calculations based on your spending numbers. But let's say it's 3,000. So you could sort of model inflation this way for the first few years of retirement, and just to see, what that does to your plan. And remember, we were at 80%. It dropped it to 72%. We were at 88. So that's pretty significant. Now, if we bump up to optimistic, we're still at 99%. So the big difference between Empower and new retirement, one, Empower does a lot of things for you behind the scenes, which I like. New retirement gives you a lot more control over the nitty gritty. So again, I use them both. Empower is free. New retirement actually has a free version. I use the paid version. I want to say it's $120 a year. I should know that. I think they're both great, but they're both very different tools. But the real takeaway, regardless of what tool you use, it's really important to stress test your retirement plan, and then to run some what if scenarios to see how you might address those potential issues. All right. So with that, let's see if I see Vinyl. Vinyl, you're just on YouTube all day long, aren't you, man? All right. Vinyl says we could live to be 140. So yeah, the funny thing is, one thing I didn't mention, I probably should have mentioned it in the main video, but if you're spending less than 3.5% of your portfolio in year one, certainly if you're less than 3%, for sure, the longer you live, the more money you're going to have. You'll be accumulating, at least based on historical standards. In fact, we can look at FI Calc, which I think I did this a while ago. This is assuming a 30-year retirement, $1 million portfolio, 40,000 withdrawal. But let's make this a 30,000 withdrawal. So that's 3%. And let's change this to 100 years, which I think is the most you can do here. Look at this. It has a 100% success rate. And when you look at the Indian portfolio values, they're just crazy, right? And this might even be, let's see what, I did this the other day on the show. Yeah, even at 3.5%, 35,000 on the $1 million portfolio, you've still got 100% success rate. So it's when you start to get closer to that 4% number, and a lot of people are there, where these stress tests become really important. But the one thing that what I just showed you very quickly doesn't account for would be a really big spending shock, like a healthcare issue. So it's a good question from Rap Freak. How close to retirement to start thinking of stress testing? Well, I would think at least 5 years, at least. Uh, and the reason is this: you as I mentioned when we were looking at the tools, one of the ways to deal with a possible shortfall in a retirement plan is to change your retirement date. And so you don't want to wait until 2 weeks before you're going to get that golden watch and call it a day to think about this. And so there's some planning involved. Part of it also depends on your age too, because if you're still working, but you're in that age where you can take Social Security, maybe you're 62, don't plan to retire till you're 67. Well, you should already be thinking about Social Security and Medicare for that matter. And so part of it depends on your age, but I would think at least 5 years before, because I would think at that point if you're already thinking about what sort of either financial advisor to hire to help you or retirement planning tool to use. So I think 5 years. There might be an argument for longer. I certainly don't think the risk here is only one-sided, right? The risk isn't that you start thinking about this too soon, right? The risk is you start thinking about it too late. So if you're going to err on one side or the other, I would err on the side of starting to think about this too soon. So Dave, hey Dave, is Warren Buffett going to live to be 300? I got to tell you, I don't know. In some ways, I think he's aging more than Charlie Munger, and Charlie's 99, right? I don't know. Anyway, all right. What else we got? So JMC says already retired, dealing with health issues. So obviously health care costs, very important topic. It's one of the things I like about new retirement that Empower doesn't do, is that you can set inflation rates specifically to your medical costs. And I didn't go into that really. I showed it to you briefly, but there's also panels on dealing with Medicare and what insurance you're going to buy, and obviously very, very important. All right. By the way, unrelated, but for those that watch the live show, I talk about things other than money. Aaron Rodgers getting hurt, that was just awful. And then the ending of that game, amazing. All right. So I don't know that, let's see. Sue asked, if you look at the detailed cash flow, inflation is not built into the spending each year. I'm assuming you're talking about Empower. And I'll show you, I'm just going to make a guess at what Sue is referencing. And I didn't show you this, but here, detailed cash flow table. And yeah, my hunch is they're showing it to you in today's dollars. But clearly, inflation is being accounted for because we see the chance of success change dramatically when we increase inflation. Having said that, I'd have to actually go into their papers to make sure that that's true. Well, I know it's true that inflation is being accounted for because you see the chance of success change dramatically. Let's just see. I mentioned this paper before. Whoops. Yes. Yes, that's different. That's income. We're looking at expenses. These are all income. We assume 3.5% for inflation by default. We subtract 1% from performance to represent current market conditions. That's interesting. I hadn't actually focused on that before. And I guess what they mean by that is that stocks are based on historical norms high, but also feed, trade costs, and behavioral mistakes. That's interesting. I'm just doing this quickly. You guys can go through this in more detail. These are just growth assumptions. Yeah, I don't see inflation specifically to expenses. So, but we saw the chance of success change dramatically. And since the numbers in the detailed sort of spreadsheet-like table are all the same, I've got to believe that they're showing them to us in today's dollars. But I suppose I can reach out to them to make sure. This is a great question. Gene, are all Monte Carlo simulations the same? No, they're not. Well, first of all, they can be different in terms of the number of simulations they run. Empower runs 5,000, New Retirement runs 500. How important that is, I guess more can't hurt, but they're also different in another way. And so let me show you this. So this is New Retirement. We're assuming optimistic, right? And this chart is showing you projected savings. And you see there are two lines there. This top line, light green, uses whatever returns the optimistic return you put in for each account. And it just assumes that that's the return every single year. The lower line here that's darker green is actually using Monte Carlo analysis. And it's kind of assuming not a worst case, but almost a worst case, because it's saying you have a 90% chance of having at least this much. All right. I guess they could have gone all the way down or up, if you will, to a 99% chance of having at least this much. But so there are going to be 10% of outcomes that are actually worse than this. But so this is using Monte Carlo. But the inputs matter. What do you put in there for your assumed average return and volatility? And so if we change our assumptions here, they change the inputs to match these assumptions. So if we use average, they're going to use that, and they're going to automatically change the volatility assumption. They do that on their own. We don't have a place to put in there what we think the volatility will be, and that's why when we go to average, they both change, right? Because now they're using our average rate of return, the average between our pessimistic and optimistic. But down here in the dark blue or dark green, sorry, the numbers have obviously changed because the input to the Monte Carlo analysis has changed, right? And if we go to pessimistic, same thing. So when you're dealing with a Monte Carlo analysis like Empower, which go back to that, is up here, and you don't control the inputs, right? Well, you're relying on Empower to control the inputs, and different Monte Carlo tools can use different inputs. I mean, even if they're using historical data, I mean, that doesn't answer the question completely, because what historical data are you using? Going back the last 100 years, the past 50, what markets are you using? Are you using S&P 500 for stocks or something broader than that? And so yeah, I mean, you could and will get different results for different Monte Carlo simulators. I suppose you might argue you should use 5 of them if you want to. I suppose, I guess there's probably a diminishing returns after a point, but yeah, it not all Monte Carlo simulators are equal. All right. So Vinyl wants to know how they model inflation on portfolio returns. Spending will be impacted by inflation, but what about stock market? So I just saw a video for New Retirement where they don't actually directly change the return assumptions based on inflation. They do change the spending, of course, but they do point out that in their Monte Carlo analysis, particularly if you set it to higher returns, you're going to have higher volatility baked in, which could actually lead to some worse outcomes, even with higher returns. But in terms of a direct impact on inflation, they don't make any adjustments to the returns themselves because of inflation. I mean, they do point out that asset values tend to go down, right, as inflation and interest rates go up. It's true for any asset. It's a mathematical calculation when it comes to bonds, but all assets values, right? Because you're going to ultimately compare it to some, a risk-free rate of return, and so stocks, artwork, Bitcoin, everything goes down. Now, you might not always see it clearly, because particularly in the short term, there's all kinds of things that affect asset prices, right? I don't know about Empower. Let's go back to this. Go back to this because we were looking at it for expenses, but they also had it for returns. Those are income. Yeah, let's see. Taxable. Your aggregate investment account growth rate subject to drag 20%. Oh, that's the other thing, by the way. New Retirement does a much better job on tax analysis than, I mean, yeah, than does Empower. So that's another thing to keep in mind. Oh, that's the accumulation phase. I don't think that answers your question. Growth assumptions, your aggregate investment account growth rate adjusted for inflation. So they might treat them differently, the two programs. That's a good question. Can you select your withdrawal strategy? So in Empower, the short answer is no. But I'll show you something that you might like. So with Empower, you set your spending, right? You don't set a 4% rule or Guyton Klinger, or you don't do that, and you don't do that in New Retirement. Now, New Retirement they do have this here withdrawal strategy, just your spending needs. So that would go back to what you put into your expenses, a max spending and a fixed percentage. You do have options. I need to drill down into these more because I find them, particularly the max spending, confusing, and I'll show you why I find it confusing, unless they've changed it since I've last tried it. So let's go to optimistic for a moment. No, we'll go average. We'll use average, and we have 72% chance of success. Now let's go to max spending, and it's hard to tell. I've actually never seen that outcome before. That's funny. Here's what I don't understand about the hard to tell is that I would think max spending would say, here's the most you can take. And, at least based on historical or Monte Carlo average analysis, have whatever, an 80% chance of success or whatever benchmark you wanted to create. So I don't get the hard to tell. I hadn't seen that one before. Let's go to optimistic. See what we get. Still hard to tell. So they have that. I don't know that, I've yet to really embrace this. You can look at your money flows here. So, but let me show you something else, a different tool that you might like to answer your question. And I've talked about this one before. Let me sign. It's called Projection Lab. Got to remember my login. You can actually use this for free. Yeah, so I'm using a login. So if you log in, this is like a new account for me. I have my own account, but this is like, I used a different email here. You can use this for free, just you can't save your data. If you want to buy, pay for it, you can save your data. We'll use sandbox mode. And we'll just pick one of these, late career single, fine. And it fills in some basic data, and you can play with the tool. And I would follow all of, I'm going to skip the tour, but once you know how to use this tool, it's easy. But there's really a learning curve to all of these tools, and you got to really spend some time to learn them because you can get just one little thing wrong, and it can really mess things up. But what I wanted to show you, if you go to current projection here, and it shows you a bunch of data on income, net worth, expenses. Again, there's tons of things to look at. But what I wanted to show you that I think might answer your question on withdrawal strategies. Let me make sure I get it. Drawdown order. No, I don't want that. That's new. Is that new? Huh. That's interesting. What I'm looking for is not here. Why is that? I wonder if I have to log in and it's part of the paid version. Oh, here we go. Oh, it's not in the top. All right. So normally I find it up here, but it's down here. Anyway, you can see that he's got this tool has a withdrawal strategy. And when you use a withdrawal strategy, the one thing that I would mention is it overrides all of your expense and stuff, right? It's just using a withdrawal strategy. And then you can pick initial percentage. That'd be like the 4% rule, right? But you can see they've got fixed amount, ratcheting safe withdrawal, that comes from Kitz's, variable percentage withdrawal, which is the Bogleheads approach. They've got Guyton Klinger. So, you can put, and then you got to fill out some things, and because there's guardrails, this one's a little more complicated, and it will show you the results of that. And there are a lot of assumptions in terms of historical data that they're using. So you definitely want to spend some time learning this tool and learning how the withdrawal strategy feature works if you're going to go that route. I'll drop a link to this tool below the video when we're done. Empower definitely doesn't have that kind of feature, and neither does New Retirement. Hope that helps. Noreen, good to have you. Noreen keeps this place running like on schedule on the live Q&A. In terms of inflation, I don't know. I don't know if I were building a tool, I would have returns adjusted for inflation. I would have the returns. I would adjust spending for inflation, right? This makes sense to me. I don't know. So this is a really good question, Rick. Have you ever put the same assets into both tools and compared? I've actually tried. The problem is, and I tried this with Maxify too, which is a tool built by a gentleman. I was actually on his podcast, a professor from my alma mater, Boston University. The problem is all of the tools have inputs that are just different enough that I didn't find it useful, the results to be all that useful. And you can see that with Empower and New Retirement. Empower uses historical return data based on your asset allocation. And with New Retirement, you put in your return assumptions. We're right there alone. It's like, how do you compare those two? I don't, right. Look at Vinyl here. He's showing off. My spending is 1% of my portfolio. No wonder he's on YouTube all day. He doesn't have to do anything. He doesn't have to worry. He doesn't need a finance. You doesn't need Empower or New Retirement. You don't need any tool. Just need to make sure, you got access to your money. All right. Well, here's a good question from Jamie. Does New Retirement have a setting to model the spouse on Social Security disability insurance? I guess, full retirement age. I don't know. You certainly could model it as some kind of income, right? They have Social Security, but this is not disability. This is, retirement benefits. If you open one up, you've got claiming age and all the things you would expect. And you, by the way, they also have a tool that will help you calculate the optimal time to take Social Security. But I don't think they have something. So you could model it here. I believe you could, but not as something labeled Social Security disability insurance, unless I have missed it. Yeah, which is very possible. These are complicated tools. I know them well, but I certainly have a lot to learn too. Stephen has a good question. From a retirement plan perspective, should you draw down on principal assets or live off of profits? Well, if you can live off of dividends and interest, and you have a portfolio that's pretty much covering the market, or in other words, you're not investing in crazy things because they have an 8% yield, right? But the problem with that, by the way, is their total returns will most likely underperform the market. But if you have your basic market portfolio and you can live on dividends and interest, that would be a highly successful approach. Why? It's not because you're not selling shares. That's the thing people miss. There's nothing magical about just spending the dividends and interest as opposed to selling shares, in my opinion. The reason it would be very successful takes us back to Vinyl and his 1% spending rate. You'd be living off of, we'll call it 2% of your portfolio. I mean, the dividend rate yield of a S&P 500 is about 1.5%. I guess it's higher now on a bond portfolio. So maybe depending on your stock bond allocation, maybe you're at 2.5%, but you're living off a very small slice, relatively speaking, of your overall portfolio. That's why it would be successful. The real downside of living off of dividends and interest is the behavioral issue. You could find yourself saying, well, I'm just going to go all into T-bills because I got 5% I can spend now. And what you're going to end up doing long-term, or a good chance, is hurting your overall total return, which is really what matters. So, yeah, that's my answer to that question. Hope it helps. All right. Let's see. I think that's about it. Noreen's had to leave. See you, Noreen. Oh, one thing I wanted to mention that New Retirement does that Empower doesn't. Let me show you. Because this is an important part of sort of the what-if analysis you might want to run to deal with some of the stress tests. If we go to, I think we can just go to profile. Yeah, if you go to profile, you see this key information. This is income and savings by sources, projected expenses, very useful. And then you have taxes. And here, here's federal tax brackets. Now, what happens for a lot of folks is that if you retire before you start taking Social Security, and that's certainly, of course, you'd also not have RMDs, you'd have a number of years in here with maybe virtually no taxes. And even in this model, we have a number of years here where our tax bracket is much lower than it will become later in retirement, much lower, right? So one of the things you can model in New Retirement you can do two things actually to address this issue. One is Roth conversions, right? And they have a Roth Conversion Explorer here, which you can run through, which is very good. And then in money flows, I believe, yeah, you can actually model a Roth conversion. I'd forgotten, we actually have one here in this plan. But you can model, and it gets very specific, the amount, age, which account you're going to use to convert, and so on. The other thing you can do, and yeah, it's right here as well, are transfers. And so the idea here would be, maybe you've got some years where your tax rate is really low, but you need to spend the money. So converting to a Roth, I mean, you can convert, but then you're just going to, assuming you're 59 and a half or older and don't have to worry about the 5-year rule on conversions, you're just going to pull the money out. It's like, what's the point? What you could model just with transferring money from a traditional, say, IRA to your taxable account. So, because the way New Retirement works is its spending order is taxable accounts, traditionals, and then Roths. But you can effectively override that by picking a Roth, say a Roth IRA, selecting it as to not be used for drawdown. So I'll show you how to do that. We could come here and say, let's edit this, exclude account from withdrawal strategies. Yes, exclude this account. And by the way, you could the other thing you can do, this is even more, I guess, advanced. I don't know. You could break this into two accounts. If you're not linking your accounts, which I don't with New Retirement, you could break this in two and have two different balances. One for transfer, which I'm going to show you, and the other for just to go ahead and continue using this withdrawal strategy, right? Anyway, you would exclude it, and then you go to money flows, and you'd start these transfers. And I won't walk through it all, but basically you can put in the years. So I'm going to transfer $40,000 a year from the age of 62 until 67, and that's when I take Social Security, and then the transfers will be over, right? And yes, it'll trigger taxes each of those years, right? You're taking money out of a traditional IRA, but they're low tax years for you, so you're paying taxes at a lower rate. And then once you hit your RMDs, of course, your RMDs will be lower because you'll have less than your traditional IRA. So, a lot of different things you can do with New Retirement. All right. Well, I think I'm going to call it a day. Hopefully you found this helpful. As I mentioned, I'll add the Projection Lab link below the video. It's a good tool as well. And there you go. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, best thing money can buy is financial freedom.